All right, I guess we can start. So, welcome everyone for today's call. Alan Peterson from First Internet Bank. He's actually one of our valuable lending partners to many of our accelerators, and he brings deep expertise in SBA financing. But he might not dwell too much on that today, but he'll be taking over to actually start with his topic. So, Alan, please.
Yeah, absolutely. Thank you, Andy. I appreciate the opportunity to be here and see some familiar faces and anyone that I haven't met yet. My name is Alan Peterson. I'm a senior SBA lender with First Internet Bank. All I do is business acquisition financing and partner buyouts or expansion, right? So I only deal in that space. I don't do like debt refis or franchise startup, things like that. I'm not really a generalist. This is all I do. And for that reason, I work with a lot of first-time buyers and try to do the best job I can, working through the process. SBA can have some challenges, right? That's no joke. But what we like to try to do is at least, parallel process steps we can to try to get ahead of things, to identify those landmines before we run into them, right? And that's really what I like to do. I was going to have my friend and colleague Kevin join me, but he's flying back to Chicago now. We were in Orlando for the International Business Brokers Association event, where I'm actually still in Orlando, coming to you live from a hotel room. But it was interesting because it's a continuing education piece, and I've got mixed feelings on brokers, as I've shared with Rich a couple times before. But it was good because they were talking about industry trends, and every indicator that was sourced shows that this is still a great time to be buying businesses. We anticipate more deals coming out shortly, which is what we're hoping. As we get into Q3, that is kind of what their energy is, right? So that's exciting for us. But the way I work with folks are two key ways, right? So what can I do for you? One, we do bank pre-qualifications. So that is quite simply what it sounds like: a letter from the bank saying that you are qualified for acquisition financing up to X amount. That helps you frame the project and along your search, making sure that it's the right opportunity, right? And then the other thing, of course, is deal review, because P&Ls versus SIMs versus business tax returns at times can tell three different stories, right? We've all seen that to be true. Through the SBA 7A program, I'm underwriting exclusively to the business tax returns, but I'm still happy to do a trust and verify cash flow review on a P&Ls. If that's all that is available, we acknowledge that very often brokers won't release a full package until you're under LOI, right? But if it's ever just giving you some quick feedback on a deal, on the cash flow, on what the working capital need is, or you're simply looking to get a bank pre-qualification, those are the two key ways that I can help you early in your search. With that, I know there's a lot of noise about SBA. I typically do not prepare for these things at all, because my favorite is transparently is questions and answers. I feel like the best use of your time, if I'm going to hop on and take an Acquira meeting hostage, is for you guys to let me know what I should be covering. Because if I just drone on and on about the government guaranteed loan program, it can be a little boring, right? So it's with that. I mean, I'd love to see if there's any questions out there. I don't see a chat, but I don't know if Andy, you do. If anyone has any questions, or I heard this about SBA, or how do you look at that, or any high level questions, I'd love to be able to answer. Or if not, I can keep going. I'm just about the kind of deals we look for, but definitely here to help. Looks like Phil.
Yeah. Thanks for joining, Alan. So I had a question about the SBA loan. I think one of the conditions was that we had to exhaust all other funding options first, so like getting a traditional commercial loan before getting like an SBA loan. So do you have any tips or tricks, or maybe that's completely wrong understanding of how that works? But it seems like most people would have to apply for like a commercial loan first or other loans, and demonstrates that that's been exhausted first.
So what you're talking about, Phil, it's called the credit elsewhere test. and that's up to the SBA's SOP interpretation. A conventional loan would very rarely be used in the acquisition for a first-time business buyer. A traditional commercial bank might do if you own a business and you're buying a competitor, by all means. But generally, the way the credit elsewhere works is that no conventional loan is going to offer 90% leverage. So as far as that goes, Phil, if you wanted to pursue a regular commercial loan, by all means, you should. But just be advised that generally they're playing in that 60 to 70% LTV. So obviously you have to put more down. But yeah,
put an order in.
You applied for anything prior to for SBA.
Got it. So just by the fact that we're trying to get like 90% debt, right, it is going to help us to qualify for that SBA loan.
100%, yeah. So we do a ton of SBA loans, and no one sends me a proof of denial from a conventional bank. It's not.
Thank you.
No, good question, Phil. Thank you for asking something. Eli, it looks like you have a question. Oh, I think you're on mute, unless it's my computer.
There we go. Can you hear me?
Yeah, all good, man.
Okay, yeah. So we've been looking at a plumbing company now for 3 or 4 weeks, and Dana Bickford's on here too. So we've been going back and forth, and so this is kind of specific and kind of in the weeds on a deal. The deal started out $3.5 million. In Q1 of this year versus Q2 of last year, with a very stable company over multiple years, has had a decline. And the company is ready. They're just ready to be. They've been trying to sell it for a little bit, but they have really good tax returns up to 24. But now they are offering $900,000 in cash, and then to leave the AR minus AP, which was $600,000. So gross $1.5 million. So you kind of come out to a net $2 million. Off the purchase, off the $3.5 million. What we were, Dana and me were trying to think and wanted to ask about, like, what that structure would look like. Would you go after the $3.5 million and then actually keep that $1.5 million of cash and AR? Or do you go in and say, you keep all that, we'll only take out say $2 million, and then you have $300,000 for working capital?
Yeah, so I mean, what I would say there is I would lean on your experts here. That's a Rich Coppage question, and I don't mean to come to answer you like a politician, but this is what the bank cares about, and this is always there's always misconceptions about the bank. I don't put a valuation on any business for any reason, right? All I'm analyzing is the verifiable free cash flow to service the debt. So that being said, depending on, what the nice part is they're leaving all that AR. The benefit there is you don't need to borrow from the bank likely, right? That's going to come with the deal, right? So that's definitely a benefit to you in that regard. But as far as the final structure, from the bank perspective, it's really going to come down to what the tax returns tell me that the business can really support. You know what I mean? And plumbing is hot, obviously. We've done plenty of plumbing gigs. Also dig a little deeper too. Find out why the year to date is down. Find out if they were doing a lot of commercial construction projects that came home to roost, and maybe that work in progress isn't as strong as we'd hope it to be. Those are just what I would say at a high level. Because from the bank perspective, when we see a Q1 drop and for years of consistent performance, we want to know why. And obviously you need to know why as well, especially if they're trying to sweeten the deal now. Q1 they show a loss, and now they're going to give you $1 million in cash. I'd keep digging there.
Okay. Was there anything else you wanted to ask, Dana?
No, I think from a broader perspective I've heard from a number of different directions, Alan. Sort of rumors, to me they're rumors, I don't know if they are or not, but just really a change in the maybe unofficial change in the way the SBA is looking at credit criteria for these kinds of loans. And to the extent that you can speak to that, it would be very helpful, I think, to the entire group.
Yeah, absolutely. So, like First Internet Bank, obviously I've got a bias. I work here. I've done a lot of loans here. But what you're going to find to be true, Dana, is that there's bank rules and there's the SBA SOP, right? So every bank needs to honor the SBA standard operating procedure. Okay, that's it. Everyone does. Me and Wells Fargo, identical in that regard. Other banks, however, have their own policy and criteria above the SBA's minimum requirements. Us as a bank, we don't have overlay, that's significant. The only major difference is the SBA's minimum debt service coverage ratio is 1.15, which is very skinny. And the bank, I personally like to see a 1.35, which I still think is rather skinny, to be transparent with you. But I mean, I think when you're thinking about transition and you're talking about ownership, you definitely want to make sure that it's strong because things can happen, right? That's when the real work begins. But Dana, I would not agree with you respectfully that the SBA has done that. I would say that what they have done is they updated the SOP recently, which you likely heard about, but we returned to the same rules we had forever. So the 2-year gap in the change of the rules was abnormal. The rule changes were simply a return to what they've been doing forever. And every bank has different appetites right now in the acquisition space. We're still lending very, bullishly in there. That's what we do as a group. So I would say that the SBA itself, I'm just not seeing that to be true. And I mean that sincerely, Dana.
So no formal requirements for increased equity contributions, more cash in the buyer's account after the transaction. Those sorts of things may change depending on the credit criteria of the bank involved, but not necessarily the SBA. And those are more informal than anything else.
That's exactly right, Dana. And also remember that the SBA SOP is open to interpretation. Yeah. So what that means is that if we can make a good use case with my chief credit officer, hey, the deal might be weak here, but it's strong there, and there, right? Yeah. Then we're able to get around different things. But the SBA actually has no guidance on post-close liquidity, as you've identified, right? That's not a rule. So it's a bank preference. We like to see 5% post-close, but I've certainly done deals for people with less, because the deal is strong in other ways. I hope that's helpful, Dana, if we're talking.
Yeah, very much so. I wasn't sure exactly how to interpret it, but I was hearing it from multiple directions, and it made no sense to me because they were all a little different and all a little. It's subject to interpretation. So thank you.
We see that all the time, Data. Like even at the conference I was just at, like some of my other friends in the banking world, in the lending world, by no malicious intent, but they misrepresent their rules as the SBA rules, right? You know what I mean? They're like, oh, we got to put 20 down. Why would you put 20 down? If you're going to put 20 down, go raise some funds, put 35 down and go conventional. You know what I mean? Like the benefit of the SBA is the leverage in my real opinion. But yeah, that's a common one, Dana. Like, oh, SBA says you got to put 20 down. It's just not true,
Yeah. Second question for you. Similar topic. We've encountered it before. And the issue really for you, I've known a number of clients that have dealt with you very successfully, and that's been awesome for them. The question I've got is addressing the working capital needs of the companies after close. And I've seen some issues there that need to be well thought out and maybe not always have been. Tell me what flexibility you have, First Internet Bank has, in helping these entrepreneurs address those issues.
Well, we rely on the quality of earnings or the proof of cash that you guys provide me with. Okay, so I'm using that. I'm doing bank analysis, and we're still overfunding any way that we can. For example, if we identify a 90-day cash conversion cycle as it relates to AR coming in the door, I'm certainly going to put enough cash to support you longer than 90 days, right? So at least 4 months. Now, if you're talking about post-close needs, you fund your deal, you close in June, and you have a project coming up in October. By all means, as an existing client of the bank, you can certainly come back and look into a line of credit or even permanent working capital, cash at close to balance sheet. So Dana, that's what I would advise is, post-close, the one thing is I got to know about it, right? If I don't know that you're in a cash crunch, I can't help you, right? So
Right.
if you close on a deal and you know that I got this project coming up, I want to hire some people, I want to material is going up, whatever it might be, I need $250,000, I need $500,000. Let me know, because the bank is happy to do that. All you have to do is explain the why, and we already have all your financials on hand. In the example I used, they were looking for cash 6 months post close. Most of the financials are not even stale dated, right? So we can get into action fairly quickly there, if that's what you're asking. Forgive me if
Yeah. No. It's that, but it's also beyond that in terms of the early on going into the transaction, making sure that there is adequate working capital planning. And
I think financial due diligence is absolutely imperative. Okay.
Yeah.
The bank is going to do their own underwriting. They're going to do their own forecasting. They're going to use averages. They're going to do the best they can do. Third party financial due diligence is nothing you should sleep on when you're talking about providing an unlimited government guarantee. Get financial due diligence, make sure it's a super legit provider, and make sure that they call everything out. That's it.
Yeah. Okay. Thank you. Go ahead.
I was just going to say that also goes towards the business planning that should be happening during the due diligence and the acquisition timeline.
Exactly.
Alan's going to ask for a business plan. I think sometimes AEs will kind of like gloss over it, throw a business plan together just kind of as a CYA to cover themselves for the loan. But I talked about this a couple of weeks ago on the call that your business planning should be thought out thoroughly from the standpoint of not only working capital management, but your CapEx spend down the road, employees you're planning on hiring. You need to really think about how you plan to grow this business over the long term and include that as part of your plan, so that at least someone like Alan or whoever you're using has an idea. Even maybe you don't need that capital up front, but they can even plan on their back end to kind of facilitate that in a manner that makes sense.
Yeah, that's a good point, Rich. And also, what I like to bring up too with the business plan specifically is it should be an exercise that when you're doing it, you're thinking of stuff that you didn't think about initially, right? Like it should be the business plan exercise is not just to check the bank box, and it does. Let's be honest. We asked for a bunch of stuff. I don't deny that. But however, the business plan is nowhere where you want to skimp, because it actually should be a mental exercise where you're thinking through, what does my year 1, 2, 5, and 10 look like? And if the answer is a big old PE exit after year 5, I don't blame you. There's nothing wrong with that, right? But what are we going to do between day 1 of ownership and that year 5? And to Rich's point, if it's something where there's 6 vehicles that are kind of older, we know we're going to need to replace those vans, or we're going to put some more techs on the road for HVAC resi repair, for example, right? What we want to make sure we can do is give you a line of credit so you're not paying interest on that money. And when it's time to use it, you simply draw it and then pay it back down. All those strategies I can help with, but I got to know up front, right? So to Rich's point, like the business plan is definitely helpful. And then again, just financial due diligence. What's the historic performance? What's the monthly burn? What's the average turn time? And then we get all that together.
Thank you, Alan.
Working capital. That's a good topic. Yeah, no, thank you.
One near and dear to everyone's
Drinking lemonade. Don't mind, I'm still on vacation.
Maybe.
Yeah, for sure.
Maybe Alan.
I mean, undercapitalization, it's, yeah.
Well, maybe, I know we're in Florida and we kind of talk about this, but maybe it'll be a benefit to the rest of the group as well. Maybe kind of hit on why you think the SBA kind of went back to the way it was 2 years ago, and kind of what they saw as far as changes in the marketplace, which may or may not been, may not have been the correct, viewpoint, specifically for loans that we're trying to close on.
Yeah, no, absolutely. So, the return that we had, the main things that changed the M&A space, the rules that returned is, 1, if a seller is going to retain any equity, they need to provide a personal guarantee for 24 months. Now, the SBA just announced they will not require the seller with retained equity to pledge their personal real estate. So they're still guaranteeing the loan though. So if they're holding 1%, they have to provide a guarantee for 24 months. That rule really affected us because in licensed trades, it was a great strategy to have the seller retain 1%. That is no longer something that we're able to do. Another thing is the seller note. Okay, so your equity injection, SBA will finance 90% of the project. That 10% can come from you, it can come from investors, or it can come from a seller note to contribute to 5% of the total 10% coming into the deal. So previously, the seller note would count as equity injection. Think of that as your down payment. That's all it means, right? The seller note could be on standby, so no payments due for 24 months. Then they would begin payments with no balloon. That is out. The only way the seller notes can contribute to allow you to come in with 5% down is if that note is on standby for the life of the loan. So these are 10-year term loans, right? So it's something where to get the sellers on board with it, strategy that I have seen already, quite frankly, is paying a little bit more for the business, but knowing that that 5% is on standby. So the seller still gets their cash at close desired, and we still get to put 5% down, which preserves our post-close liquidity and allows us to look at larger transactions. But I do say that acknowledging every seller is different, right? Everyone, the amount of rapport you have with the sell side is so important. Rich, we talked about this in Fort Lauderdale, right? Because like you were doing mid-market where it's just numbers. Main Street, lower market deals, this 1 to 5 million debt space that we play in. I really just want to reiterate to anyone on the call how important the psychological element is when you're negotiating. We don't see sellers going with another offer over $5,000 if they really, really like our buyer. It is the case. The other thing is private equity firms are buying down lower and lower. I don't know if that's good for humanity or not, right? That can be debated. But private equity is buying deeper. What we have the benefit of doing is when the seller understands that you are going to preserve their culture, that means more to them. And I'm sure you guys go through this on your calls. I just wanted to share that with you because I've been noticing it more and more in my pipeline where sellers are like, you know what? This is the individual for the job, or these are the two, these are the people that aren't going to come in and kick out Janice, who's been in the back office for 15 years, right? And that stuff matters more. I just wanted to share that. And Eli, looks like the hand was up. What's going on?
Yeah. So kind of just back on the down payment thing. How do you guys view? So like with Acquira, I'll have $150,000 investment into Acquira. How does that look as far as skinning the game, or does that have anything to do with skinning the game towards the deal?
Yeah, it does. It counts. It's a direct project expense, and First Internet Bank and myself specifically honor that. So any money that you spend on Acquira fees goes towards your total down payment. Every penny of it. Okay,
so even though it's not actual equity off the deal, you look at it as whatever percentage that is of the deal.
Yeah, so Eli, to be really clear, this is where it gets dicey. When we think about the deal, we think about buying the business. We're talking about the acquisition. In my world, we're talking about the project. The project is the acquisition, working capital, closing costs, deal-related expenses. So what I'll do is give it its own line item and write, $150,000 advisory, Acquira fees, and then I'll credit you with that 150 right back. For example,
if you $700.
Well, but yeah, we're good on those items. We honor all those, Eli. So no worries on that.
Yep.
I should have led with that. People are always like, "You can really do that," and I do it so often I forget to bring that up. But anything that you pay out of pocket with Acquira certainly counts to the down payment. Hi, Ben. How are you?
I'm good. Good to hear from you again, Alan.
Yeah.
I'm in the car, not driving.
Yeah.
But I've got a question for you about financing. I don't know if you would call it a turnaround or maybe a business and ramp. I'm looking at an Ace Hardware in Denver that was just put up a year or two ago. They're kind of still in the ramp phase. They're not, the cash flows aren't completely positive yet. But I've talked to the broker and he seems pretty confident that they could turn positive in the next couple of years simply because the business is new. He says they're beating all of the metrics that Ace Hardware has. I still need to talk to the seller, but I just wanted to understand more generally, like how you feel about financing turnaround businesses, what that might look like, and what information you need.
Yeah, no, absolutely. So if you had, a compelling case, we can certainly look at it. If there's a lot of direct experience there where, you can turn something around, we can certainly look at it. The vast majority of acquisition entrepreneurs that I'm working with I would not recommend them trying to do a turnaround on their first deal, transparently. The other thing too is, Ben, you said the broker acknowledged that they're beating every metric Ace has, well, except for turning a profit. You know what I mean? I just remain diligent is all I have to say about when it comes to turnarounds. If someone's selling after 2 years, there's a reason.
Yeah. Okay. And then I had one more question for you while I have the stage.
Yeah.
What is the best way to finance an asset-heavy business? I've heard about SBA 504 loans. Those are amortized over a longer period. Is that right? And so let's say, like I'm looking at this molding manufacturing business. They have like $1 million in assets, like CNC mills and that kind of stuff. A lot of machinery. And then, would you price that separately than the business?
No, the 504 loan program, business acquisition is not an eligible use of proceeds. While you're correct about the 504, and I'm glad that you're doing some good SBA research, the 504 is for real estate and heavy equipment only. So what you're saying is asset heavy business, there would still likely be a value to the goodwill of the actual business. So you wouldn't be able to do that. If you're talking now instead of I want to buy the building with a 504 and do everything else with the SBA 7A loan, that would not be anything that I would do personally. But I mean, I would explore it if that's interesting to you.
Yeah. And then in another instance, I'm looking at a carpeting business. They do installations and they have a showroom. They're saying the real estate is worth $3 million and the business is worth $2.5 million is what they're asking. Would you split that using the 504 for the real estate and then a 7A for the business itself?
No, I don't do 504 lending at all. So
you don't? Okay.
No.
Okay, just 7A.
Yeah, because I only do business acquisitions, Ben. You know what I mean? So like the getting in the weeds with the CDC and the two approval process involved in the 504 just isn't conducive to our business model here, But by all means, it's certainly a strategy worth exploring. I acknowledge that for sure. It's just not what I do.
Okay, gotcha. I didn't know there were specialized bankers. One did the other, but good to know.
Yeah.
And also depending on how much cash you have,
right.
If you're not going to go through the SBA route and you've got an asset heavy business, one of the other options is to basically go to an asset based lender. They're probably going to give you 40 to 50% of the deal if it makes sense. Well, obviously they're going to assess what the fair market value of the assets are because that's what they're really lending against in that situation. So it could be probably most likely, and Alan can correct me on this because he's a banker, he knows this, but it could most likely be anywhere from maybe a 30% loan all the way up to 40, 50, 60%, depending on the nature of those assets and how marketable they might be given a situation if they had to take back the loan for whatever reason. You'd have to come in with a bigger cash component from that standpoint.
Okay, so you can combine that with like purchase the assets using an asset-based lender and then the business using a 7A loan. Is that possible?
I don't think you can.
I mean, it's technically possible, but the one thing that might not be being considered here is that the SBA requires a first position UCC lien. So what happens then is like we're carving out the assets that the SBA by program design is supposed to be encumbering, right? So if in theory, what you're explaining makes sense that you'd be able to do it, but most 7A lenders just won't, just being really honest with you. I mean, I'm not saying no one will ever do it, I'm just saying that what you're describing would be abnormal for strategy. Getting someone to do the 504 and the 7A, I think you can find a home for that. But when you get into, because it's all SBA, so it's all the same lien from the Small Business Administration. When you get into ABL or asset-based lending, that's where it gets dicey with the UCC and the lien position, Ben. That's why you'll find banks won't be as willing to do that in a lot of cases.
Yeah, that's why I said you would be going simply to the asset-based lender for the debt piece of it, and you'd have to contribute the equity or find another either equity investors that kind of help fill that gap, because you're going to have a significant gap there, and or some sort of a sub debt lender that would come in underneath that asset-based loan.
Okay.
Alex, coming in here, Rich and Alan, I think, if I'm hearing correctly, though, we haven't covered the advantage of the blended rate and amortization.
Specifically for using a 504 loan for real estate?
7A.
So 7A, when we have 51% or more of the proceeds are going to commercial real estate, then it's a 25-year term, right? So, and if it's less than 51% of the total project, then it's a blended term. So it'll be longer than 10 years, but less than 25, based on the actual, how much of the project is the real estate and how much is the goodwill, right? So that's ultimately the blend there. The difference is, though, when the loan goes longer than 15 years, the prepayment penalty exists. So that's year 1, 5%, year 2, 3%, and year 3, 1% of the outstanding principal. That would be the prepay penalty. For loans less than 15 years, there is no prepayment penalty at all. In fact, most of the loans I do are 10-year, as they're for just the businesses themselves. The secondary market data shows us that it would be abnormal for you to hold this loan longer than 5 years. The vast majority get refinanced into conventional commercial or paid off right at the end of the 4th year. That's what the data suggests, at least. So that's the one thing to call out. So you get a longer term, right? So you can get a potentially lower payment depending on how much that real estate is valued. The only catch is the prepayment penalty becomes a thing.
Okay. Thanks, Alan.
Yeah, absolutely, Ben.
Can I piggyback off of that comment? Is that a typical strategy where people would start off with the SBA loan since it's a larger loan payment and then they transition or refinance into a normal commercial loan?
After 3 years of ownership, people are generally exploring refinance opportunities if they still have the debt. In my experience, when you have 3 years of your name as the owner on the tax returns, that's enough of a track record to get into a community bank that might be located by you, right? And they want the relationship. They want the credit card processing. They want, all that stuff. And in exchange, you generally get a lower cost of capital and it's less, it's like less covenant. So that's one thing that you might be able to do, Phil. I can't guarantee that you can do that, but I can tell you many of my clients have done it after 3 years, some even after 2.
Got it. So it is a typical strategy and it does actually decrease your cost of capital.
That's correct.
Yeah, sorry. So that wasn't my main question. my main.
No, that's cool, man. I like just doing Q&A for this reason, to be honest with you. Like this is more interesting for me selfishly, anyway, Phil. So what else do you got?
Yeah, so I'm actually looking at acquiring a restaurant franchise that's in the city of New York. So I'm wondering, from like a franchising perspective, does that actually change strategy or any sort of considerations for an SBA loan?
Yeah. So if you're looking to buy a franchise that's existing, then everything stays the same. Mm-hmm. The one document that now becomes important, Phil, is your franchise disclosure agreement, right? They're called FDDs. It's the franchise disclosure document. Excuse me. And just make sure that you look at the FDD, look at all the sections, because it'll show you all of the historic performance of the brand, including what the top performing store does and what the bottom does, right? So that helps you just understand the true performance. Also, look at the amount of stores that are open, Phil. One indicator that's on the FDD that sometimes can be overlooked is they claim that they've opened 5 new locations this year. Okay, well that's an indicator of a growing brand. That's a positive thing. But as you dig deeper, you'll find that these are corporate-owned stores that they had to buy out independent operators. Well, why did the independent operator want to turn in the keys, right? So those are just things to kind of keep your eyes open. And that's all the FDD, Phil. Other than that, it's financed the way we would any other industry at all. It's all about the cash flow on the tax returns. If you're acquiring it, if you're starting up a franchise, then all that we're looking at is the FDD, right? Because there'll be no historic performance to gauge.
Yep. I'm looking to purchase just an already established brand. So
okay, yeah. So it'll be the same deal, right? It'll be the same exercise of finding that verifiable cash flow on the business tax returns. And if you have that, you could be in good shape.
Awesome. Thank you.
Yeah, no, absolutely. Hey, Eli, what do we got?
All right. Oops. Good. Sitting on my desk here. So I had a question then on the down payment side. What the raising capital versus like subordinated debt versus equity of outside investors. What does that look like? Or can you just raise cash and do it, or does their cash have to be converted to equity in the deal?
No, I mean, if you're gonna raise money from someone not in the deal, so to speak, if they don't own 1%, they're not minority partners, they're just, throwing money at you, then we want to understand what that is. If it's a loan, then we just need to calculate that loan repayment in the total cash flow. If it's a gift, then we just get a gift letter similar to if you're buying a house, right? Just, this is a gift, it will not be paid back. If that is the most common though, is people have, 1% or whatever it might be.
Okay, but so if I raised $100,000 and put that in, I can just use that $100,000 as equity.
Yeah. I'm sorry. I think I misunderstood you. So of what you described, all of those scenarios are totally acceptable to us. We are super investor friendly because all we do is SMB ETA deals. You know what I mean? So like in the self-funded search world, it's very common to have investors. We don't care. I don't mean to oversimplify it and say we don't care where the money comes from, because that's not exactly true. However, we're not that picky with where it comes from, as long as you explain it to us. There's no seasoning period at my bank. That's a common question people have.
Yes. Yeah. A lot of times. Yeah. Because I think earlier on I heard you had to have like the money for 6 months. So I had to have it for 6 months.
Yeah.
Of a seasoning period before I was allowed to turn it in. And then I heard that using investor money was still, which it is still a loan, but then it makes your LTV, it keeps making your LTV go up because you're not actually taking any debt off the table. But
yeah, I mean, there's yeah. I mean, look, at the end of the day, equity costs more than debt. I don't care what Wall Street Journal Prime is. That's my bias, and I'm sticking to it. But if you have like good strategic investor people around you that you're also getting like advisory from, you're getting game from, maybe industry experience, those alignments, those are awesome. I like them a lot, and more importantly, my chief credit officer does as well. But to answer your question directly, there's no seasoning. That's another example of well-meaning people that do what I do, miscommunicating their bank policy for SBA policy. SBA has no rule on seasoning.
Okay, so but no matter what, I still have to have my 5%, and then outside of that, it can come from anywhere. Or does that include even my 5%?
No, your 5% never has to come into the deal at all. I mean, if you're doing $1 million project and $100,000 is coming into the deal, and 100,000 of that is coming from investors, maybe you've got a rich uncle. I wish I did. I don't. I'm still looking for one. But I don't care where it comes from. If you get that $100,000 into the deal, Eli, you don't need to put any of your own money on your PFS. In fact, I would rather you didn't, because it improves your post-close liquidity and helps me get an approval easier.
Okay, that's a good clarification. Thank you on that.
What I will say though, Eli,
Yep.
is that your investors, if you're not putting any money into the deal and you're raising all this money, they're going to question it from a standpoint of you have no skin in the game from their side.
Yeah, right.
So Alan may not care, but at the same time, your investors, your investors may care.
Yeah, so
they're going to care.
At minimum, I've got the acquirer invested money. So
Yeah, no, to Rich's point, this is all assuming you can get these guys who are generally a lot smarter than I am on board with you coming in with nothing at all. Good luck, but it is possible. It is possible.
Yeah. Here's a great thing, but I don't want to put my money in it.
Yeah, right. You know, oh, it's a home run. How much are you putting in? Well, nothing.
Yeah. Okay.
Yeah, but no, from the bank, we don't care. That's the truth.
Okay.
Oh, what do you got there, Carl?
Yeah, sorry, I'm having some internet problems here, so I'm going to stay off camera. I got a quick question I have to run. Alan, I guess my question goes back to down payment versus, I guess, how strict the SBA or you guys are as far as down payment compared to valuation. I guess let me put that into context a little bit. I keep going back to this company that I like. The problem is actually he's scaled the company rather drastically over the past number of years. So I'll go the past 3 years, he's gone from a discretionary earnings of about 570,000 to 740,000 to just over $1 million. Now my problem there is he's essentially valuing the company obviously off the 2024 earnings.
Right.
My problem is that's a lot of growth in a fairly short period of time. And how is that going to look as far as the SBA is concerned, or you guys?
Yeah, so what we do, again, not to answer like a politician, but I have no opinion on valuation. I can talk to you about valuation. I can talk to you about the multiples I see. I follow the SMB world very closely. We can have opinions on it. But my professional, like what I do from the bank perspective, valuation happens after approval, before closing. We will get an unbiased third-party business valuation completed. If the business valuation comes in lower than what you're paying, we need to talk about it, and we need to identify why you are willing to overpay for the business. That's the only rule on it. So if you go, I'm willing to overpay because I really believe that this trajectory is consistent. I think that they're going to have an amazing 26. They've got some great contracts. That's why I'm willing to pay more than, you guys are saying it's worth. That's all that we need to do. But, to your point, it's really, really hard to get comfortable for, a seller has 3 rockets in a year. Are they retirement age?
More or less, yeah. The guy's been doing this forever. He inherited the company from his family. He's basically used born.
Yeah.
And he just wants to.
So if there's a good exit, if there's a good exit narrative, then, by all means, we can, then continue. But we got to be careful when people are flipping.
Right.
A new good year, then we just say the words trailing 12 SDE over and over.
Right. Yeah. No, this is not
in this world.
Situation. Yeah, it's not a flip. It's not a quick flip or anything. He's just kind of got his life together, basically, and they rocketed the company. I guess my question there is: are you still looking at a 10%, or is it kind of like real estate, where valuation did not come in at offer? You need to cover the delta now.
So the SBA loan we can loan you money for what the business is valued. So if we approve your loan for $1 million and we get into the business valuation and it's only worth $850, at that point, yes, you got to put more cash in the deal, or the seller's got to hold a note for the delta. We're not going to loan you more money than the business is worth.
Okay, that was gonna be one of my thoughts, my approaches of this one.
Yeah, for sure.
A large forgivable note or something. So.
Exactly. And that's a really great strategy, Carl, to be honest with you. It's the chicken and the egg part. It's hard, though, because we don't get that valuation until the loan's already approved. And then we have to go back and do change memos and stuff. But at the end of the day, if the business tax returns support the cash flow, I have never seen a valuation come in that didn't match a purchase price. So I can share that with confidence.
That's good to know. All right. I appreciate it.
And the trick is making sure that you get to that normalized cash flow number. Understanding what that normalized cash flow number is that's happened over the last 3 years, and then kind of what that looks like over the next 3 to 5 years on your side. And if you're paying in the range of 2 to 4 usually for that type of cash flow, you're probably going to be okay on the valuation that Alan ends up getting. You're probably going to be within range, and you should be okay from that standpoint.
He wants 3.5. So he's a little high, but he's not.
He's not on Mars or whatever. So that's good. I mean, to be continued on that one. But I think you're aligned there. You'll be all right.
All right, appreciate it.
Mm-hmm. Eli, what do we got?
Back here. All right. Back questions. So kind of back to the scenario of this company we've been at, where they're looking to leave a large amount of money in the company. When looking at the 10% down payment, so they were asking 3.5 and looking to leave essentially $1.5 million. Is it looked at that to borrow 3.5, a guy needs 350,000, 10% to use those cash funds from the business?
In a total change of ownership, the SBA requires 10% of the total project to come in the door. So to answer your question very directly, if you're 3.5 and they're leaving cash, or 2.7 and they're not leaving cash, either way, you're going to need the cash, is my thought, right? So whether the bank gives it to you or they leave it, ultimately the project is going to be very similar, Eli, right? And for that, and it's still 10 into the deal regardless of what they leave behind. It's beneficial when they're willing to leave things behind, for sure, but we wouldn't say like that $1 million in cash is counting towards the down payment or anything like that.
Okay. So that the deal, the project is still 3.5, and I still need to find another 350,000 additional to bring in to make my 10% of the project.
Yeah, or you can, if you have Acquira fees, if you spent 150 there, then remember that counts, right? So you're not looking for as much as you think. And then the other point to that would be, you can, if you're really feeling wild, you can get the seller to hold a note for 5% on standby. If you can get them to do that, give them a little bit more than they want, 5% on full standby, count your Acquira injection, and now you're playing ball with almost. I mean, 150 is 5% of 3 million, right? So you're almost there.
Okay. Do you think that it'd be worth it to tell them to keep more of the money and have a smaller purchase price, or does it kind of even out in the end?
It's the same thing, because they're going to leave it and you're going to pay for it dollar for dollar, or the bank is going to give you the working capital that you're paying. Yeah, so it's really up to you, Eli. If there's any benefit, I don't know which way would be better. It's the same thing for you at the end of the day.
Okay. Thank you.
And part of that is figuring out what that normalized working capital number is and including it in the price. That way,
right,
so that if you come back and they're like, well, we're not going to keep the working capital in the deal, then, like as Alan said, you can then adjust the purchase price to account for that money, because you're ultimately going to have to borrow it or what have you. So.
Yeah, because I know, so they had it pre-qualified by their banker that they use, an SBA banker, and they ran it like 180,000, which we figured was more like 300. So there was gonna be like 1.2 million of like extra money outside of working capital that I don't know, you either pay it down, or just have them keep it and just go with a $2.3 million project cost. And instead of having that extra 1.2 hanging around, I guess. So that is more on we need to figure out which way you just want to do that.
I never trust the pre-qualified SBA banker deal. Meaning, and Alan knows this. I mean, no offense to Alan, because he doesn't do this, or maybe he does. I don't know. But anytime a deal is like pre-qualified by the seller's banker, it's usually horseshit, to put it another way. So,
and I don't do that, Rich. I don't pre-qualify deals for brokers. I only work with buyers anyway.
So a lot of this will get flushed out when you do the QOE. If they don't have solid financials that you can review at some point during the due diligence process, we'll flush out what that normalized working capital number should be. That should be included in the price, and we'll kind of move forward and adjust accordingly as we kind of work through the deal.
Mm-hmm. Yeah, and the working capital too is a living document to that point, guys. So remember, like if I give you a term sheet, if we review a deal together, cash flow looks good. You get with Rich, he's on board with the structure. You come to me, Alan, do you want to offer this? We're looking for this kind of seller note. And I put together a term sheet. Just remember that if your working capital figure changes through like deeper financial due diligence, 9 out of 10 times we're adjusting that anyway, right? So just understand that if you get a term sheet with, 500 grand in working capital from the bank, that figure may change. And in fact, they do change very often, depending on what the quality of earnings dictates is really the normalized number. So I just want to call that out as well, that don't feel pressure that it's got to be to the penny, because as we work through it, the bank is always willing to adjust and add more if it's determined to be needed.
What is the best way to send you this information on like a deal review, or just have you look at it?
Yeah, just via email, I just do a lot with just regular email. I've got Kevin Bromberg on my team. He'll jump through the spreads really quick. I got another guy, Josh. So I still do it myself as well, obviously. So if you just email it to me, I can let you know what we're thinking. All I need to know is, what do you think you're going to offer? Where is your head at with the deal? What do you like about the deal, and what do you not like about the deal? And if you can tell me those things, then I'll work as devil's advocate to prove what your assumptions are correct, or give you another opinion on them. But I try to be within 24 hours, Eli, give you meaningful feedback. I try to be. I'm out of office right now. I'll be back in Wednesday, but from Wednesday for the rest of the week, I can turn it pretty quickly.
Okay. All right. Awesome. Thank you.
Yeah, of course. Anybody else have any questions about the riveting government guaranteed SBA 7A loan program? All right, well, good. Then we covered a lot of ground, it looks like. If anybody needs anything, let me know. Obviously, the Acquira team knows how to get a hold of me. Feel free to share my email, my cell phone number. Like I said, I'll be out of office until Wednesday, but always willing to talk to anybody about any scenario. If you've heard this is true, how do you look at that? Do you have experience with this type of deal? All the above. Anything that I can do for you, I will. I'm grateful for the partnership with you guys. So anything that you need, feel free to rely upon me as a resource to you, whether you end up using me for financing or not. That matters very little to me, to be totally frank with you. I am here as a resource for you.
Thanks, Alan.
I'll share
absolutely.
Alan's contact number.
Alan, thank you.
Or
Yeah.
I'll share his contact details later after this call.
Awesome. That sounds great. Well, thank you for having me, Acquira team. Great to see you guys virtually. Andy, to see you in person. You're always the person I email, and you just make everything happen immediately when we're traveling. So I can tell you thank you in person. And Rich, always great to see you guys well. And like I said, guys, anybody that needs me for anything, please reach out. I'm eager and excited. I love what I do. You're never a bother. SBA is complicated. If you do not have questions, I don't have a job. And I got 2 kids, and they're young. So I got to have a job. All right, guys? So don't be afraid to use me for whatever I can do. Okay?
Thanks, Alan.
Thanks,
See you guys.
Alan.
Bye-bye.